Listen carefully and imagine a scene that feels completely authentic. Not some made-up scenario, not a classroom illustration from a finance book. Picture a genuine American family room in a quiet neighborhood outside Tampa on an ordinary Tuesday afternoon during March of 2026. The woman sitting there is named Linda. She is 68 years old. The casseroles neighbors brought after the funeral are still packed away in her freezer. Her husband, Robert, the man she married when she was only 22 years old in a tiny church near Akron, Ohio, is gone. Robert spent 38 years working as a regional plant supervisor for a mid-sized industrial supply company. He wore the same gold wedding ring for decades, even after his fingers became swollen from blood pressure medicine. 9 weeks ago, that man died. Massive heart attack. Saturday morning, in the garage, he had been changing the oil in the Buick. Now Linda sits alone at the kitchen table. Reading glasses rest low on her nose. A pile of unopened mail sits beside her. There's a yellow legal notepad in front of her, and there is a letter from her CPA that she has already read 4 separate times because she still cannot make sense of it. She does not want to understand it, because what the accountant is actually saying, hidden behind polite professional language, is that the federal government of the United States is preparing to remove nearly $73,000 from her retirement savings this year. And remember something important. Their retirement account did not suddenly become larger after Robert died. Robert and Linda did everything the right way. They paid off their mortgage. They contributed to the 401k. They stayed away from credit card debt. They drove old vehicles until they practically stopped running. They represented the textbook image of a responsible middle-class retired American couple. Yet now the IRS is effectively reaching across Linda's kitchen table and taking $73,000 from her in 1 calendar year. The year before, their tax bill had been roughly $18,000. Same retirement accounts, same required minimum distributions, same traditional IRA. In fact, household income actually declined after Robert passed away. Linda lost 1 Social Security check, the smaller of the 2. Her yearly gross income dropped by close to $28,000. She has less money than before. She is grieving. She is living alone. Yet her tax burden has exploded. That is what people call the widow's penalty. And if you are married right now, and either you or your spouse owns a traditional IRA or a 401k with a meaningful balance, then you need to understand something immediately. The IRS is not operating as your ally. The IRS is not neutral. The tax code contains a built-in mathematical trapdoor that opens the moment one spouse dies, and almost nobody is warning ordinary Americans about it. Not your stockbroker, not the banker at your local branch, not the generic financial planner with framed certificates hanging on the office wall. Most people do not hear about this trap until there is no time left to fix it. So for the next several minutes, I am going to explain exactly how it works because I am tired of watching surviving spouses lose huge portions of their life savings to a system designed to punish single filers after a death. But before we go further, do me one favor right now. Hit the like button immediately. I am serious. Because financial education content aimed at older Americans gets buried by algorithms constantly. These platforms do not push this information toward the people who need it most. The IRS benefits when grieving spouses sit alone at kitchen tables without guidance or support. Every single like helps push this video into the feed of another married couple who still has enough time to prepare. Subscribe to the channel. Turn on notifications. Join the archive before these platforms decide to suppress financial survival education completely. We are building a private collection of financial survival manuals here, and you will want access to it when that letter eventually arrives. Now, let me walk you through Linda's numbers step by step so you can fully understand the scale of this problem. Back in 2025, Robert and Linda filed taxes as married filing jointly. Their combined income looked like this. Robert received a monthly Social Security benefit of $3,100. Linda received $1,900 per month from Social Security. Combined together, their Social Security income totaled about $60,000 annually. Robert also had a small pension from his company worth approximately $18,000 each year. They owned a traditional IRA valued around $740,000, mostly from Robert's old 401k rollover. His required minimum distribution that year was roughly $28,000. They also owned a taxable brokerage account at Schwab worth around $220,000 invested mainly in index funds that generated close to $6,000 annually in qualified dividends. In addition, they had 3 CDs at their local credit union totaling about $110,000 earning approximately 4% interest, which created another $4,400 in yearly income. Add everything together, $60,000 from Social Security, $18,000 from the pension, $28,000 from the RMD, $6,000 from dividends, $4,400 from CD interest. Their gross income as a married couple in 2025 came to approximately $116,400. Now pay attention to the trick hidden inside the tax system. As a married filing jointly couple in 2025, Robert and Linda received the standard deduction worth around $30,000. They also qualified for additional deductions because both were over age 65, adding roughly another $3,000. On top of that, they received the senior bonus deduction created under newer legislation worth approximately $6,000. After those deductions, their taxable income dropped to around $77,000. And here is the major advantage of being married in the eyes of the tax code. The 12% tax bracket for married filing jointly couples in 2026 stretches all the way to nearly $97,000 of taxable income. That means Robert and Linda paid 10% on the first portion of income and only 12% on the rest. Their total federal tax bill ended up around $8,400 despite earning more than $116,000 in gross income. Their effective federal tax rate was roughly 7%. Now comes the part most people never see coming. Robert dies in January of 2026. Under IRS rules, Linda is considered a single filer for the entire tax year because filing status is determined based on your marital status on December 31st. There is a small exception known as qualifying surviving spouse status, which can temporarily extend married filing jointly rates for 2 years, but only if you still have a dependent child living with you. Linda's children are 41 and 38 years old. They own homes of their own. They do not live with her. So Linda receives no grace period at all. In 2026, she files as single. Now look at her revised income picture. She loses Robert's Social Security payment, reducing household Social Security from $60,000 down to $37,200. Robert's pension included only a 50% survivor benefit, so the original $18,000 pension becomes just $9,000. The traditional IRA still sits near $720,000 by the end of the year, and Linda's required minimum distribution remains in the high 20s, approximately $27,500. The brokerage account still generates $6,000 in dividends. The CDs still produce $4,400 in interest. Add the numbers together. $37,200 from Social Security, $9,000 from the pension, $27,500 from the IRA distribution, $6,000 from dividends, $4,400 from interest. Linda's new gross income equals roughly $84,100. Her income dropped by more than $32,000. She lost nearly 1/3 of the household's previous income. She is financially worse off than when Robert was alive. Now watch what happens next, because this part should infuriate every married American approaching retirement. As a single filer in 2026, Linda's standard deduction is effectively cut in half to around $15,150. She still receives the additional age 65 deduction for single taxpayers, worth approximately $2,000. She also still receives the senior bonus deduction of $6,000. That leaves Linda with taxable income near $60,350. Here is the critical math almost nobody calculates. The 12% tax bracket for a single filer in 2026 ends around $48,475. Linda's taxable income sits well above that number, which means she now crosses into the 22% bracket. Every dollar earned between $48,475 and $60,350 is now taxed at 22%. Her federal tax bill jumps to roughly $7,700 under the standard calculations. But that is only the beginning, because another hidden blade falls immediately afterward. Linda's provisional income is now high enough that 85% of her Social Security benefits become taxable. And the IRS formula for taxing Social Security becomes far harsher for single filers than for married couples. The provisional income threshold for single filers begins at $25,000. For married couples, it begins at $32,000. The protection shrinks dramatically, so suddenly Linda's Social Security income, which previously received partial shelter, becomes almost completely exposed to taxation. And we have not even discussed IRMAA yet. IRMAA stands for Income-Related Monthly Adjustment Amount. It is essentially a Medicare surcharge added onto premiums. While Robert was alive, their joint income stayed comfortably below the married couple IRMAA threshold, which in 2026 sits near $212,000. They paid standard Medicare Part B premiums. After Robert dies, Linda is measured against the single filer IRMAA thresholds instead. The first IRMAA tier for single filers begins much lower. Linda's modified adjusted gross income, including her RMD and taxable Social Security, pushes her into the first IRMAA bracket. Her Medicare Part B premium rises from roughly $185 per month to around $260 monthly. Her Part D prescription coverage also gets hit with an additional surcharge. Combined, the increase costs Linda roughly $900 more every year for the rest of her life, all because she became widowed. Now combine everything together: higher federal taxes, more taxable Social Security, increased Medicare premiums, reduced household income. Linda now pays dramatically more tax despite earning substantially less money than before. This is not an accident. This is not some random flaw in the system. The tax code is functioning exactly as designed. Pause for a moment and think honestly. Have you and your spouse ever sat together and modeled what your taxes would look like after one of you dies? Have you ever calculated what happens to your retirement income under single filer rules? Most married couples never do because nobody encourages them to run the numbers. The truth is that the widow's penalty contains 3 separate mechanical traps stacked on top of each other, and many CPAs only discuss the first layer. Trap number 1 is bracket collapse. We already walked through it. The 2026 tax brackets for single filers are roughly half as wide as the married filing jointly brackets at nearly every level. Look at the 22% bracket. For married couples, it stretches from about $96,950 up to more than $206,000. That gives married taxpayers over $100,000 of bracket width. For single filers, the same 22% bracket stretches from roughly $48,475 to around $103,000, about half the width. The same pattern repeats at the 24% bracket. It repeats again at the 32% bracket. The tax structure heavily favors couples, and when one spouse dies, the survivor suddenly drops through a financial trapdoor. Trap number 2 is the RMD crossfire. This catches retirees who believe they can simply spend less money to lower taxes. Unfortunately, required minimum distributions do not care how much money you actually need. The IRS does not care whether you are grieving or struggling emotionally. The RMD system forces withdrawals from traditional retirement accounts based on percentages determined by life expectancy tables. Whether you spend the money or leave it sitting in your bank account does not matter. Once the funds leave the IRA, they become taxable income. At age 73, the divisor sits around 26.5. By age 75, the divisor shrinks further. By age 80, retirees withdraw close to 5% of the account annually. By age 85, the number approaches 7%. The IRS steadily forces more taxable income out every year, and when those withdrawals hit the compressed single filer brackets, the result becomes financial crossfire. Forced withdrawals plus smaller tax brackets equal larger tax bills. Trap number 3 is the IRMAA spike. This one is especially dangerous because Medicare surcharges use a 2-year look-back period. Your 2026 income determines your 2028 Medicare premiums. Imagine a surviving spouse decides to perform a Roth conversion the year after losing their husband or wife because their CPA finally recommends it. That higher income may trigger an IRMAA surcharge that does not appear until 2 years later. By the time the increased Medicare bill arrives, most people no longer connect the surcharge to the earlier tax decision. That delay is not accidental. The system is designed so ordinary retirees struggle to connect cause and effect. So understand the sequence clearly. The bracket collapse hits immediately after death. The RMD crossfire continues every year afterward. The IRMAA spike appears 2 years after major income events. Once the funeral is over, escaping the system becomes extremely difficult. The best opportunity to protect yourself exists before death occurs. Which raises an obvious question. Why has this problem existed for decades without meaningful reform? Because policymakers have known about the widow's penalty since the 1980s. Economists, think tanks, and tax analysts have written reports about it for years. Brookings discussed it. The American Enterprise Institute discussed it. Financial journalists occasionally mention it. The information has remained publicly available for decades, yet Congress repeatedly chooses not to fix it. Why? Because the widow's penalty quietly generates enormous amounts of federal revenue. Every year, roughly 800,000 new widows and widowers appear in the United States. Many surviving spouses hold traditional retirement accounts worth between $250,000 and $1.5 million. When bracket compression forces those survivors into higher effective tax rates, the government collects billions in additional revenue. The IRS calls that revenue. Most grieving families call it confiscation. So share this information with a married couple you care about. Right now, not later. One honest conversation between spouses today could save the surviving spouse tens of thousands of dollars over the next decade. Now let us talk strategy. There are 4 major asset categories that married couples should review before a funeral ever happens. Asset number 1 is the traditional IRA, traditional 401k, SEP IRA, or any other pre-tax retirement account. This is usually the largest source of widow's penalty damage inside a retirement portfolio because every dollar inside a traditional retirement account represents future ordinary income. The IRS has not taxed those dollars yet. The government allows the account to grow because it expects to tax a larger balance later. After the first spouse dies, the surviving spouse inherits the account and continues taking required minimum distributions under single filer tax rates. The most effective strategy is aggressive multi-year Roth conversions while both spouses are still alive and filing jointly. This may be the single most important move in retirement tax planning. Here is why. While married filing jointly, couples can fill up the 22% tax bracket together. That creates enormous room for conversions at lower rates. A couple could convert $100,000 from traditional retirement accounts into a Roth IRA during one tax year, pay taxes today at lower married rates, and permanently move that money into a tax-free environment. Once inside the Roth IRA, future growth becomes tax-free. Withdrawals become tax-free. Required minimum distributions disappear. And most importantly, when one spouse dies, the surviving spouse inherits a Roth IRA that does not generate taxable income. Run the math carefully. Suppose a married couple owns $800,000 inside a traditional IRA at age 68. If they never convert it, the surviving spouse may eventually withdraw between $28,000 and $45,000 annually through RMDs for the remainder of life. Those withdrawals are taxed under single filer rules and may also trigger additional Medicare surcharges and Social Security taxation. Over time, the lifetime tax cost could easily reach between $180,000 and $240,000. Now compare that to a structured Roth conversion strategy completed gradually over 6 years while both spouses remain alive. Taxes are paid upfront inside wider married brackets. After conversion, the Roth grows tax-free and no future RMDs create additional taxable income. The strategy transforms a recurring lifetime tax burden into a one-time controlled tax payment. That is the key move. Asset number 2 is the taxable brokerage account. This is where many advisors accidentally give terrible guidance. Some professionals encourage retirees to gift appreciated investments to children during life in order to reduce future estate size. But for married couples facing widowhood risk, that advice can destroy one of the most valuable tax benefits in the code. The secret weapon is the step-up in basis under Internal Revenue Code Section 1014. When a spouse dies and leaves appreciated investments to the surviving spouse, the tax basis of those investments resets to current market value at the date of death. Embedded capital gains essentially disappear. Imagine Robert purchased $100,000 worth of index funds in 2005, and those investments grew to $240,000 by the time he died in 2026. Linda inherits those shares with a fresh basis of $240,000. If she sells immediately afterward, she owes zero capital gains tax. The $140,000 unrealized gain simply vanishes for tax purposes. But account ownership matters tremendously. In non-community property states, jointly owned accounts often receive only a 50% basis adjustment. The remaining half keeps the original basis. In community property states such as California, Texas, Arizona, or Washington, married couples often receive a full 100% step-up. Florida does not, Ohio does not, New York does not, Georgia does not. That means account titling strategy becomes critically important. In community property states, couples should confirm assets are properly titled as community property with rights of survivorship. In non-community property states, some families may benefit from carefully structured trusts or tenancy arrangements. This is why couples need real estate planning attorneys who genuinely understand tax law rather than generic product salespeople. Improper account titling can cost surviving spouses tens of thousands of dollars in unnecessary capital gains taxes. Asset number 3 is the pension election. This one quietly devastates families all the time. Many pension plans default towards single life annuity payouts unless retirees intentionally elect a joint and survivor option. The single life option produces larger monthly payments while the retiree remains alive, but payments stop completely after death. Joint and survivor options produce smaller monthly checks, but continue paying a surviving spouse at 50%, 75%, or even 100% for life. Here is the frightening part. Many spouses sign waiver forms allowing single life payouts without fully understanding the consequences. The solution depends on timing. If retirement has not started yet, couples should strongly consider electing the highest survivor percentage they can reasonably afford. If retirement already began under a single life payout, reversing the election is usually impossible. However, there is another strategy called pension max. Under this approach, the pensioner keeps the larger single life pension while purchasing a permanent life insurance policy designed to replace lost pension income after death. When the pensioner dies, the surviving spouse receives a tax-free insurance death benefit that can be invested or used to purchase guaranteed income. Under Internal Revenue Code Section 101A, life insurance death benefits are generally income tax-free. That means the replacement income stream can effectively avoid bracket compression, IRMAA surcharges, and RMD problems. Mathematically, the pension becomes a tax-efficient survivor income strategy. Asset number 4 involves CDs, money market accounts, and taxable bond portfolios. This is the slow financial leak many retirees overlook. Most retired couples hold somewhere between $50,000 and $300,000 in savings products producing ordinary taxable interest each year. While both spouses remain alive, the interest income hides inside wider married tax brackets. But after one spouse dies, the same interest income flows into compressed single-filer brackets and may trigger additional Medicare surcharges. The solution involves restructuring fixed income assets before widowhood occurs. One option is replacing high-yield CDs with high-quality municipal bonds issued by the retiree's home state. Interest from qualifying municipal bonds is exempt from federal income taxes and may also avoid state taxation. The interest still affects Social Security calculations, so the result is not perfect, but federal income taxes decline substantially. Second, retirees can use multi-year guaranteed annuities, often called MYGAs, which allow interest to compound tax-deferred inside the contract, rather than appearing annually on a 1099. Third, some families use properly structured cash value life insurance policies or modified endowment contracts. Growth accumulates tax-deferred, and death benefits generally pass income tax-free. Different states create different advantages. Florida residents already avoid state income taxes, so municipal bond strategies may offer less benefit there. MYGAs or insurance-based solutions may work better. Ohio residents face moderate state taxation, making Ohio-issued municipal bonds more attractive. California residents with high state tax rates may gain enormous value from California municipal bonds because the effective tax equivalent yield becomes extremely powerful. Now think about what happens if a married couple successfully executes all 4 moves before the first spouse dies. The traditional IRA gets converted gradually into Roth assets, reducing future taxable RMDs. The taxable brokerage account is titled properly, allowing maximum step-up in basis. The pension either includes a survivor benefit or gets backed by tax-free life insurance proceeds. The CDs and taxable bonds become structured for tax efficiency. At that point, the widow's penalty loses much of its power. In Linda's situation, instead of paying massive taxes and Medicare surcharges every year, her total annual burden could potentially remain close to $8,000. Same overall wealth, different account structure. The difference over a 20-year widowhood could preserve more than $1 million of family wealth. Now listen carefully because this next point matters. The planning window is smaller than most people realize. Roth conversions require time. Ideally, conversions happen gradually over 5 to 7 years to avoid triggering excessive tax brackets and Medicare surcharges. Pension elections often become irreversible once payments begin. Life insurance underwriting requires both spouses to remain relatively healthy. Trust restructuring requires legal capacity and proper documentation. If one spouse is already seriously ill, many planning opportunities disappear immediately. Once the diagnosis arrives, half the tools may already be unavailable, and the IRS understands that. The system quietly assumes most couples will delay planning until it becomes too late. Many Americans wrongly believe their default retirement accounts, standard brokerage arrangements, and ordinary pension elections will somehow protect surviving spouses automatically. They will not. The default settings inside the American retirement system are designed primarily for revenue collection, not survivor protection. So if you are married and watching this right now, tonight is the night to start. Sit down after dinner with your spouse. Open a notebook. Write down 4 categories: traditional retirement accounts, taxable brokerage accounts, pension elections, CDs and bond portfolios. Beside each category, write exactly what you own and how every account is titled. That is step 1. Step 2 is finding a fee-only fiduciary advisor or estate planning attorney who truly understands widow's penalty planning rather than someone focused on selling products. Bring your notebook, run the numbers, build the strategy together. And if this discussion helped you, frightened you, or made you angry, then do 3 things before leaving. Like the video. Subscribe to the channel. Turn on notifications so the next financial survival guide appears the moment it is published. Then share this information with at least one married couple you care about. The IRS is patient. The system waits quietly. Every year, hundreds of thousands of new widows and widowers fall directly into this trap. But it does not have to happen to your family. The tools already exist. Ironically, the same tax code that creates the widow's penalty also contains the escape routes needed to avoid much of the damage. You simply have to learn those rules before the funeral arrives. I will see you in the next video. Stay alert, stay informed, and for the sake of your family's future, move those 4 assets before the IRS gets its opportunity.